Hey, Ben Jenke with MortgageVines.com, and thanks for joining us today. Today I'm going to show you and walk you through a good faith estimate. This is a very important factor when you look at getting a new loan, because this is what people use to compare one loan versus another loan. So let's walk through this, and hopefully as I explain it and walk you through the process, it'll help you understand it and help you make a better decision when you are going to get a new loan. First of all, let's take a look at the date. The date is important because if you get a estimate from lender A on Monday and then you get a new estimate from lender B on Wednesday, it's very, very difficult to compare these two lenders because rates are changing, not just daily but even hourly. This area will show you who is providing you with the estimate. Here is one place that we obviously like to know about, and what we're getting is the interest rate. And then the term is actually laid out in months. So a 360 would actually be a 30-year loan. 180 would be a 15-year loan. Okay, let's go ahead and scroll down to the closing cost schedule. Now on line 801 we see the loan origination fee. This is typically 1%. I've seen them up to 1.6%, but 1% is what you're probably going to be paying with this loan origination fee. Now keep in mind with these closing costs that when you get a quote, whoever is providing you with a quote is quoting third-party fees for the most part. Third-party meaning the appraisal fee, the title insurance fee, the escrow fee. So a lot of times the quote tends to underestimate some of these costs. Obviously, when I do a quote for someone, I like to show them all the costs up front so they're not surprised at closing. So when you're looking at your good faith estimate, if one estimate has an appraisal fee and the other one doesn't, you need to ask why. So line 803, which is the appraisal of the property. An independent appraiser will contact you to make an appointment to appraise your property, and you will pay them approximately $400 to $600 for the appraisal, which is paid at closing typically. And that fee really depends on what state you live in, what the going rate is. Then we get to line 810. This is the processing fee. This is the processor will prepare the loan for submission and loan approval. Once the processor has completed the loan package that displays your credit worthiness, he or she will send it to the lender and it will be reviewed by their underwriter. Line 811 is the underwriting fee. This fee will range anywhere from $395 to $695 depending on what bank you are putting the loan through. The underwriter works for the bank or lending institution in which your loan package has been submitted. This is the person who decides whether or not to lend you the money. You can consider them the gatekeeper of the loan. Let's head over to line 1101. This is the settlement or closing fee, also known as the escrow fee. This typically is pretty flat across the board, from company to company, but depending on which state you are in, it may range anywhere from $200 to $600. This fee is charged by the escrow company, which is a third-party neutral company that's involved in the transaction. They ensure that everything goes smoothly and everyone is treated fairly and ethically. Let's go to the title insurance fee. This is a state-regulated fee. Okay, so if you're in a certain state, you can expect to pay the same amount for this title insurance. The title insurance is required by the lender to make sure that all of the liens and encumbrances have been taken off the property prior to this loan, and they're covered under this insurance policy. This is also protecting the current or the new lender from being moved from first position to second position by a previous lien or encumbrance that may have been on the property before you borrow the money. One big thing that I hear, and I have to answer this question quite a bit, is the title insurance fee is not mortgage insurance. Then you have a small fee, a recording fee, which will cost you anywhere from $50 to $100. Right here is where you're going to get your total estimate of your closing costs. Now let's go down a little further, and we're also going to be taking a look at prepaid costs. These are not necessarily closing costs, but these are prepaid, typically involving your taxes and your insurance. So let's go to line 901. This is your prepaid interest. This is your prorated mortgage payment based on how many days left are, how many days are left in the month at the time of closing. So you can consider this interim interest for your loan. And most lenders will collect some hazard insurance up front and some property taxes up front as well. Now, if you already have an escrow account with your current loan, you're most likely going to receive a refund of whatever is left in that escrow account at the time of closing. So a lot of these prepaids are going to actually come back to you after closing in the form of a check from your previous lender. So when you break it all down, here is your transaction summary. It breaks down to your principal and interest payment, an estimate for your hazard insurance and your real estate taxes. Those are going to be different for each property. And then your total monthly payment, including PITI. And then this is your total closing costs, which also includes those prepaids. So you can scroll down a little further. Now on this part, cash from borrower. Typically what most people do with a refinance is build this amount, these closing costs, into their loan, so you don't have to come with cash to closing. The advantage to doing that is you get to keep control of your money. You could use this $4,200 for any other type of investment. Just keep it as a cash reserve, whatever you would like, if you work that into your total loan amount. So in this scenario, the loan amount would be roughly $129. The payment would go up roughly about $20 a month, but you could hold on to that $4,200 at closing. So this all depends on your loan to value and what type of loan you're in, if this is possible. Typically, it is possible, and that's what most people choose to do. The main thing that I wanted to get across to you with this good faith estimate is that this is an estimate. Some people are putting everything into the estimate that they should be putting in there. Some companies tend to leave a few things out to get you excited about their lower cost, but when it comes down to it, you're always going to have to pay these costs. Okay, there's no way around it. If you get into a loan where you have lower closing costs, you're typically going to have a higher interest rate to counteract that. And the opposite can be true as well. If you get into a loan with a really low interest rate, chances are you're probably buying down that rate or paying more closing costs to get that rate. So this good faith estimate is a pretty much straight across the board type estimate. There's a lot of different ways you could go with this. If you wanted a lower interest rate, you could buy it down. If you didn't want as many closing costs, you could get a higher rate and have less closing costs. So to sum it all up, a good faith estimate, again, is an estimate, and you got to be careful. A lot of companies will play the shell game with you. They'll show you a better closing cost schedule, or they'll show you a better interest rate. But when it comes down to it, you got to make sure that that is something that you're actually going to obtain when you close the loan. Again, for instance, the closing costs are pretty much third-party fees. Companies don't have control of every party involved in the transaction, so closing costs should be relatively equal unless you're buying down your rate. The one thing that you need to compare is most likely the interest rate. But again, keep in mind that just because someone quotes you a low interest rate does not mean that's the interest rate you're going to get at closing. And I've heard hundreds of horror stories about people getting a lot higher interest rate than they thought they were getting at closing, or a lot higher closing costs. So hopefully this educated you a little bit about the good faith estimate and the loan process as you go throughout your time during your purchase or your refinance. And if you want any more information about this, go to www.mortgagevines.com